Welcome. The stock market's been on a nice bull run lately. If you sell covered calls, then some of your calls have probably gone in the money. This means the price of the underlying stock has gone above your strike price. If you sell leaps, long duration calls, those with expirations far out into the future, or have already rolled up and out one or more times, then you may have some calls that are deep in the money, like this chart, my Meta covered calls. I last rolled my Meta calls here in March of 2023. Meta was below 200 back then, and I rolled to a 280 strike, expiring December 2025 out here. It quickly shot past my strike here in just a few months, and it kept rising. It closed at 473 last Friday when I made this chart, February 16th, 2024. So this episode is going to focus on one specific thing you can do with deep in the money covered calls like my Meta calls. Roll them up or roll them up and out. This strategy lets you potentially capture more of the stock's price appreciation and optionally sell some more time to offset some cost of rolling up. This chart you see is representing some rolls I'm considering. All of them except the bottom right one are debit rolls, which means I'll have to pay more to buy to close than I collect to sell to open. Why would I want to do a debit roll? If the stock price stays above the strike for these newly rolled covered calls, you'll be able to sell them at the new higher strike, and you'll gain more than you paid for the roll. We'll look in detail at some rolls like this in a minute, computing some estimated returns. This is a continuation of my previous episode on my Meta covered calls. Check this one out if you'd like a boring look at how I got into my current situation with Meta. It's linked in the description. Now, I'm not claiming rolling is the best alternative. That's up for you to decide. You should also consider and compare other alternatives, like closing your call and keeping your underlying stock, closing your call and selling the underlying stock. Consider doing this if you think the stock is overvalued and deploy your funds elsewhere. You could wait, let the time value decay, or let the stock price come back closer to the strike so you could potentially get a better return for rolling. And finally, you could hedge against further upside with other option strategies designed to capture upside. But assessing all those alternatives would make for a long episode, with not enough depth on any of them. So this episode will stay laser focused on rolling deep in the money covered calls on Meta, up and out, estimating their expected returns and the pros and cons of doing these rolls. So let's go evaluate some potential rolls for my current Meta covered calls. But first, if you're enjoying this content, please consider liking and subscribing. Bear with me while I talk through a couple spreadsheets. It's going to get a little wonky, so stay strong. The first thing to do is figure out where we currently stand. The main things to know are the cost basis, which is the sum of all closed out transactions on Meta. This would include the initial stock purchase and the selling and buying of all puts and calls. That's $243.69 for me on Meta. The next thing we need to know is the closeout value. This is the sum of the remaining transactions to completely close out your current options and underlying stock. In my case, it would include buying to close my very expensive Meta calls, then selling those Meta shares that were being used to cover the calls. That works out to $245.91 per share for me. So I'm up a whopping $2.22 per share on my Meta. Woohoo! It's also useful to know the option time value, so we know how much we can yield on our current covered call. Recall that time value is the current option price minus the option's intrinsic value. My Meta calls each have a time value of $34.10 per share. And finally, we can compute the call's annualized yield by using that time value. I covered computing this in other episodes linked in the description. To summarize, it's the rate you can expect to make from your time value decaying away to zero at expiration, assuming the call stays in the money. This is currently 7.63% for my Meta calls. Now that we know where we stand, let's look at some potential rolls to see what they can do for us. Now the fun really starts. First, let's look at rolling up and keeping the expiration the same. December 2025, 663 days from now. These would all be debit rolls, which means they'll cost us money now for potential bigger gains in the future. Here's my current option on the gray line, the 280 strike. Its delta is implying a 91% chance of it staying in the money, which means my shares will most probably be called away at the strike price if I keep it open until expiration. And there are 663 days to expiration. Let's look at the first potential roll to the 300 strike. It's going to cost $14.58 per share, actually probably a little bit more. I'm using the midpoint of the ask bid for these numbers, which is usually a little better than you can expect for your fill price, but close enough. Anyway, I digress. Our net gain from doing this roll, assuming Meta stays above the 300 strike price at expiration, is $5.43. This is the amount we gained from the higher strike, 300 minus 280, or 20, minus the debit we paid for the roll, $14.58. Now let's look at the roll's yield. Computing the yield on covered call rolls can be confusing. Here's how I like to think of it. The profit of the roll would be the amount we could potentially gain by rolling from our current situation, assuming the call stays in the money. This would be the net gain amount here from the new higher strike minus the debit. The collateral is the amount you have to keep invested after the roll. This is the closeout value of your call and underlying stock after the roll. So it's the value of your underlying stock minus the amount you'd have to pay to buy to close the call after the roll. My current closeout value is $245.23 per share for my Meta calls. We need to adjust this closeout value by the debit of each roll, and we'll normalize the time as usual to get the annualized rate. So we end up making an unimpressive 1.29% by rolling up to 300. But we only have to take on a very small amount of additional delta risk. There's a slightly higher chance of Meta falling below 300 than falling below 280, but it's not significant. The deltas are estimating it's only an additional 1.8% chance. The bottom line is we'll be making $543 by paying a $1,458 debit per contract over 663 days with not much additional risk. So let's look at the other larger debit rolls to higher strikes with the same expiration. They'll have more risk of falling out of the money, but will be compensated by potentially making more money. The 320 strike has a 2.6% yield if it finishes in the money. It would make an additional $1,013 by paying a $29.88 debit and carry an additional 3.9% chance of finishing out of the money. Rolling to the 350 strike has a yield of $554 if it finishes in the money. It would make $1,960 on an outlay of $5,040 with an additional 7.3% chance of finishing out of the money. And finally, rolling to the 400 strike would be the most aggressive and risky choice. It has the best yield of 12.7% if it finishes in the money. It would make $3,750 per contract on an outlay of $8,250 with an additional 14.1% chance of it finishing out of the money. Now let's look at selling some additional time while we also roll up. We'll do the same strikes and roll out an additional 6 months to June 2026. These will all be debit rolls except for rolling out to the same 280 strike. All the calculations are the same except we're plugging in the option prices for June 2026 and adding 181 days when we normalize to the annualized rate. As you can see, the yields are similar because we're able to sell some time so the debit amounts aren't so high, but that's offset by adding 181 more days to the calls. Another interesting thing to consider is the yield on the new call after rolling. This column is showing what the yield would be on the new call's time value decaying away after the roll. So which one of these is best? Should I roll it? And if so, where to? This is going to be subjective to each investor and what she's trying to accomplish. There really isn't a clear best choice for rolling, as the market's going to do a pretty good job of pricing all these alternatives. For each individual, it's going to come down to what you think of Meta, how well you think Meta is going to do, and if you want to hold it long term. Once you've decided that, you can estimate your expected gains and yields on the rolls versus holding or closing out. You'll also want to make sure to think about taxes. If you're rolling a deep in the money call, you'll be able to count it as a loss in the current year, but will probably need to realize gains in the future when it gets called away. Also consider what other opportunities you have out there and what you'd expect to yield from them. If there's something you like better, then consider closing out your calls, selling your underlying, and redeploying your capital elsewhere. My current thinking is I'll wait for the December 2026 options to come out and look at what debit rolls are available to me there. Maybe take the strike up to 350 or 400 and estimate the yield for those rolls. But I'm in no hurry to do anything at the moment. And that's a wrap. If you enjoyed this content, please consider liking and subscribing. Also, let me know what you think in the comments. I really appreciate any feedback or comments. Let me know if you agree or disagree with how I'm computing my roll metrics. I'm not a financial advisor. This wasn't financial advice. Just a look at some rolling alternatives for my deep in the money meta covered calls. Have a profitable day.